Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. And, I was looking at our example paper money portfolio this morning, and I see that mostly things are going very well, but there are two positions where I want to have a discussion because we have covered calls on these positions, and they've actually offset the damage done by a collapsing stock price. So I wanted to address this question. Can a covered call really protect a trader if the stock or if the markets crash? Is a covered call insurance on a stock position? We're going to be talking about that. Why might consider that to be a considerable misnomer? What are the pros and the cons of using covered calls as protection on a current position? And might there be some other more effective protection approaches, or let's say rather than effective, more protective. In any case, a lot to talk about. We'll be getting into that in more detail in just a moment. Before I do, let me say, first of all, hello to everybody who's already chatting in out there in YouTube. I've been keeping an eye on those chats, see a lot of familiar names already. Great to see you all. Hello there, Bob and Greg, John, Hope, Sharon, Eva, Will, Naresh, Adolfo, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation. Be aware that you're invited to join us in the live discussion. This is a Monday webcast series. We kick things off promptly at 2 Eastern time. If you'd like to be here, we'd love to have you here in our live audience. I also wanted to let everybody know that I'm joined by my very good friend, Brent Moores. Brent's going to be hanging out there in the chats with our live audience members. He's going to be addressing any questions that I can't get to, as long as they're not too far off topic. Brent's there to pick up the slack for me. Thanks for having my back there, Brent. And Brent and I would also like to issue an invitation to everybody watching. If you have an account on the platform known as X, you should be following your favorite presenters there. It's the best place to connect with us in between these live streams. You can find Brent there at Brent Moores CS. You can find me there at Cameron May CS. I was just on X this morning. I think I've chatted back and forth about 15, 16 times with my followers there on X. So yeah, great place to connect with us. But let's get into this discussion. And of course, as we do, we need to bear in mind that risk is real. So these are important considerations. Keep this information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only. It should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as the sole means of investment research. Investing involves risks, including the risk of loss, and any investment decision you make in your self-directed account is solely your responsibility. Okay. So what are we talking about today? We're talking about risk management. And can a covered call, or can covered calls really protect a trader if a stock or if the stock market is collapsing or crashing? So we're going to take a look at today's markets. So the very first thing that we're going to do, we're going to have a look at what's going on with the S&P 500 and why some traders might feel, it might be, could we tip from this very sharp ascent that we've made? Could we go down just as rapidly? And if that's the case, what steps might be taken by a trader to try to mitigate that risk exposure to the downside on existing stock positions? And I want to further set the stage for this discussion by looking at a couple of our example trades from today. But then we're going to move into a new position and talk about using covered calls, maybe to reduce the risk, but certainly not at all to eliminate it. All right, we're going to be walking through the numbers of what degree of protection the covered call might offer and the trade-offs for pursuing that protection. So let's go right to the Thinkorswim desktop platform. Here's the S&P 500, and it really has been a great recovery since that first week of April. Markets have raced up about 32, 33% to that peak, and yet we find ourselves trading just below those all-time lows. Today, markets are off just a little bit. It's measured by the S&P 500. But do some squinting for me. Let me zoom in just a moment here. As we're attempting to get above that all-time high, what does this candle look like in the early hours of trading? And it's not even the early hours. We're sort of mid hours of trading. I shouldn't have said that. We're getting close to the close. Anyway, In these hours of trading, what kind of a candlestick pattern might this look like as we're maybe bumping our heads against a price ceiling on the S&P? For some, they may recognize this as having the appearance of something known as a shooting star candle. It's a small body with a long wick sticking out the top. And for some candlestick traders, that can signal that we're about to come down from a resistance level. Could we just be going down to recent support levels, or could it be ultimately a reversal? And could a market that has gone up this rapidly come down just as rapidly? I'm not saying it's going to. I'm just setting this as a stage for getting ourselves in that mental framework, that mental position of a trader who's quite concerned and considering taking steps to mitigate that concern. Say, yeah, I think I said all-time lows, Eva. Yeah, I got it. Yep. Sorry about that. Yeah, this is obviously all-time highs. I corrected myself. I hoped everybody just forgave me for it, moved on. Yeah. In any case, yep, all-time highs there, trading just below those all-time highs here. I had skipped ahead to talking about trading below those highs and yeah, didn't come out correctly. Anyway, let's say that our trader is concerned that this might happen. Or who knows, maybe even this might happen. Stocks might come straight on down. So for some, I've heard it said before that covered calls offer some degree of protection, even somebody throwing out the word insurance. I'm going to say right now, not insurance. Nope. Can covered calls reduce risk to some extent? Yes. There are trade-offs for that, though. But let's go look at the two example trades that I wanted to cover today, because these can maybe paint an incorrect or maybe overly optimistic picture of what covered calls can do on a regular basis. So we have some Apple shares and we have some NEE shares. And if you'll notice, those are the only two positions that appear to be unprofitable right now among all of our current positions within this webcast series. But as a matter of fact, these are not unprofitable trades, because along the way, we've already closed out related positions. We've sold covered calls against these previously, that if we took those into consideration, these are actually profitable trades overall. So let me show this to you. And we'll start here with Apple. So quickly revisiting the history of Apple. It started off way back here when we sold a 21st of March 235 put, and that was assigned. We collected $3 and we assigned at 235, so that was the purchase price of our shares, 235. With that $3 realized gain on that put, that lowered our break even to 232. But ever since then, we've collected additional profits, collected premiums, realized profits, 5 additional times. Sold a call for 80-cent profit here, 149 profit here, 225 profit there, 165 profit there, 133 profit here. And we're currently in a call that where we've collected a premium of 114. Add all of those up, and even though we purchased the shares at 235 and they're trading right now at 227 and change, we're actually now trading above the break-even point overall when we factor in all of those premiums that have been collected along the way. So it is as though, wow, we've insured against the loss on this stock. Nope. As of this moment, we're above break-even, and that's because of Friday's price activity. There was a long stretch where we were trading below break-even. And we just got back up above break-even. So I don't want to give the impression that a covered call is the perfect solution to downside risk. Nope. As we've already experienced, there can be long stretches or even permanent scenarios where the trader is below break-even. So this trade, interesting. NEE is in a somewhat similar position. As we look at our NEE, we're now trading above break-even. This one we sold a put. It was assigned at 72.5. Collected a 156 premium there. We collected 55 cents there and 112 here. And that has lowered our break-even point. 72.5 minus all those premiums gets our break-even down to 68.27. And we're trading above that. So despite the stock price being below what we paid for the shares, overall, through the whole history of this trade series, we're profitable. So covered calls, boy, they would seem to be this faultless benefactor for us. It's really been helping out our trade, our trade scenario. That's the way it's happened on these two, but it doesn't always happen that way. So I want to explore the true risk and reward scenario of using covered calls to mitigate risk to the downside. To what degree do they deliver downside risk mitigation? But what is also the trade-off for that? So we actually have some shares down here in our unallocated portion. Were purchased at another time outside of this series, but some shares of CAH, 100 shares purchased at 155.40. Those are trading at 158.42, so up about $3.02. But let's put ourselves in the shoes of that trader. They own some shares of CAH, and maybe what they'll notice, a combination of calendar facts and technical factors that might be at play here, that might be getting on the mind of our CAH on our Cardinal Health stock owner. Maybe they're up a few bucks on their position, but we're staring directly in the face of an earnings announcement. And earnings, we know, can go quite well. Look at this. We've raced up on previous earnings, but they can also go poorly. Now, we haven't had one. Well, this one was a little bit disappointing, I think, for shareholders. Actually, it only went down for about a day or so and then began a period of recovery. But we all know that earnings can create risk. And maybe our trader here is thinking, I'm not really in the mood for risk right now. So I have an idea. Let me sell a covered call and get some income. Maybe that income can reduce my exposure to risk. It actually does. It does, but to a limited extent. So let's go have a look at our trade tab. Let's say that our trader, we could actually look at just the August expiration. August 15th is actually past that earnings announcement. So there might be some premium to be collected there. Let's go to the trade tab and start to build this risk mitigation approach. All right. Now I'm going to hit the pause button on that thought for just a moment, because there's a survey that's been added to our chat window. I just saw it pop in. We don't always get this. I never know when it's coming. But when you get the opportunity to give us feedback via a survey, I hope you do it every time, because every time you do it, it's useful, it's helpful to your presenter. So do me this favor, click on that survey link in the chat window right now if you're here in the live stream audience, and that'll have that survey ready for you to fill out after the webcast is over, and you can give me some honest feedback at that point. I'll just say, if you take the time to fill out those 2 multiple choice questions, if you want to, you can also fill out the comments box and the suggestion box. But I read through that data and I read through those comments, and it is always helpful. I was just reading through that this morning, as a matter of fact, for another webcast. Anyway, thank you for doing that. But let's get back to our discussion here. And let's maybe outline this example trade. Okay, so we already have an example stock. Let's make this bold. The bold didn't work. I'll do it again. But our example trade is going to be a covered call. And it begins with stock ownership, 100 shares. And right now, even though these were purchased at 155.40, right now they're worth 158.45. So I'm going to write that down, 158.45, because that's the benchmark we want to compare ourselves to, because we could continue to gain more profits, or we could surrender profits and maybe even make losses if we start to head downward, particularly if things crash or collapse. But we own 100 shares, and right now they're worth 158.45. And looking out just 4 days, boy, we could sell maybe the 160, the 162.5, the 165. Let's look at this one first. Let's look at the 165. We're going to sell, hypothetically, the 15th of August, 165 call, and that looks like we might be able to collect right around $1 for that. Somewhere between maybe 95 cents and $1.10. 95 if we're not so lucky, 110 if we get a really good fill. Obviously, prices can change, might not even be in that range by the time we place our order. But we could sell that call, collect a premium. Awesome. Now, if the stock goes down, well, we do own a bullish position in the long stock. But we also have now a bearish position in this short call that we've sold. So if the stock falls, we can feel, oh, we feel protected. But to what extent are we actually protected? In these next 4 days, let's go back to the chart, scare ourselves again. When there's an earnings announcement that goes south, how bad can it get? Is it possible that we get a really disappointing announcement and the stock gaps down to 150 overnight? Could it be horrible and we go down to 145 or 140? Yeah, let's just say 150. Let's just say it's a really bad earnings announcement and we gap down here to 150. So we suffer a setback of about $8.45 in value to the stock shares that we own. Our call has probably collapsed in value, so we might be able to exit that for pennies. Let's say that we're able to exit for zero, where we just get to expiration, and we retain the entire dollar. So we make $1 on the call that we sold. We have an unrealized loss or reduction in profits. Actually, the first $3 would be a reduction in profits, and then the next $5.45 would be unrealized losses since we bought the shares. So, yeah, that would be an $8.50 setback on the stock versus a $1 gain on the option. That doesn't balance out to me. So is this insurance? No, it's not insurance. Is it protection? To some extent. But to me, it's kind of like, this isn't the perfect analogy, but I think a lot of you can relate to this. Has anybody ever been a landlord in their lives? Have you ever owned a property and you think, you know what, I'm going to get some income from this, so I'm going to rent that property out. Let's say you own a house, you rent it out, I'm just going to use some round, easy numbers. Let's say we rent it out for $500 a month for 6 months. Great. $500 for 6 months means $3,000 of income. But let's say the tenants are not the best tenants we could have picked. Maybe they're just serious roughhousers and they just cause all sorts of damage. They ruin the carpets, they ruin the cabinets, they tear up the furniture that left there for them, $10,000 worth of damage in 6 months. If our asset depreciates by more than the amount of income generated from that asset, it's still a net loss. Now, is it as bad as if we let them stay there for free and it caused $10,000 damage? Maybe some thoughtless friends? No, but it's still a degree of protection, but it's not perfect. Now, that said, can it still help out if the stock is not in full collapse? Maybe it's just pulling back for a bit. Really, that's sort of what NEE is doing with our current positions. So 72.5 is what we paid for this. NEE, well, it actually had a pretty good sell-off at one point. We were well below break even. But if we don't come down too far, that income does have the ability to offset that sort of a capital setback. So there is a degree of protection. That's the bottom line. But if the stock falls by more than the amount of the premium collected for the time frame of the option, the protection is at best partial. Try to Zach, you like that analogy? Good. I hope that made sense to you. Sometimes I think of these analogies. I don't really test them out on anybody before I launch them, and sometimes I kind of fall flat. But what could we do if we want to dial up this protection? Maybe $1. If we really think the stock is about to collapse, is there something else the trader might be able to do to increase the amount of protection? Because really, with our stock at 158.77, we've only collected $1. That means the break even from here, well, we'll just stick with 158.45. I'm not going to mess around with the fluctuating values of the stock. 158.45 at the time we sold the call. If we fell by more than $1, that would mean our break even is at 157.45. That's going to be, just to help to visualize that, that's going to be right here. It's basically going to be inside of Friday's candle. It's not all that much protection. Mark says you could do more calls. You said buy, I think you meant sell. But yeah, that unfortunately would result in a naked call position, or maybe we could go further out in time. As we go further out in time, those calls, the call premiums tend to go up. So if we were to go to that same 165 strike, But instead of doing it for 4 days, we do it for 39 days. Boy, look at that. We might be able to triple the degree of protection, risk mitigation there. Instead of collecting $1, it might be somewhere in the neighborhood of $3. That's one thing that a trader might do. What's the trade-off for doing that? Well, instead of having an obligation where somebody has the right to buy our shares for 165 for the next 4 days, we're in a contractual obligation where somebody has the right to buy our shares for 165 for the next 39 days. Our upside is capped, not just for the better part of a week, but actually for more than a month by going out further. So yes, more protection at a trade-off. The cost is the upside potential is limited for a longer period of time. For each of these steps that the trader might take, there are going to be pros, basically in the form of larger premiums. There are going to be cons that the trader also needs to be aware of. Oh, you didn't? Okay, Mark. I knew you were joking. I definitely got that. All right. What else could the trader do? Well, maybe instead of selling at 165, requiring someone else buy the shares from us at 165 if they want them. Maybe we get into a contract where we allowed somebody to buy the shares from us for 160 at a lower price. We go closer to the current price of the stock. That also dials up the premium that could be collected. And if there's more income, then there's more damage that could be done to the asset during the time frame of the trade that can be offset by that income. So here, by moving further out in time and a little bit closer to the current price of the stock, we've gone from $1 worth of protection to about 5.5 times the amount of protection. For some traders, if they're really concerned about, let's say, an earnings announcement or something like that, let's put that on our chart. $5.5 from 158.45, if you'll forgive me the rounding of a nickel, that would bring our break-even point down here to 153. That would be all the way down to recent lows. Let's draw in 153. Oh, it's going to be below that. I drew it at 153.5, but close enough. We're up here. Could bring that break-even down here. Let's get rid of this one. That was just a hypothetical drop. But still, if we drop further than that, if the stock falls further than that, if we're suffering larger losses on our stock than the amount of income collected from the call, there's still risk exposure. At Alpha, yep, you're exactly right. Let's redraw this line. Let's activate this drawing and move it out to where this really extends to. There we go. Yep. That's more realistic about what we're discussing at this moment. We've dropped the break-even point, but we're in the trade for longer, so there's actually a cap on what we might have to sell our shares for. And that cap in this scenario is actually be right here at that 160 level. So actually we could activate this drawing. Let's activate that, pull that out here. You can envision that. Someone has the right to buy our shares. You can see where those shares are right now. I'll zoom in a little bit so you can see this in a little greater detail. That's where the shares are right now. There's a cap right there at 160. If the shares go up above that, somebody has the right to buy those shares. If they go up to $168, that's cute, but someone else gets to pay us just 160 for those shares. So there are pros and there are cons. There are different ways that the trade might be just in the selection of expiration or strike, where the trader might increase the degree of downside risk mitigation, but there are pros and cons to each of those discussions or each of those decisions. So for today's example, I think what we're going to do, let's just go ahead with the original scenario just for one day. I'm going to sell that 165 strike for the 4-day contracts. Let's go to 165. I'm going to click on that bid price. We just have 100 shares, so we're just going to do one contract here, selling that 165 call. Let's try to get $1. We'll leave that as our limit. It's not guaranteed that we'll get that filled, but we're going to try to. There is a commission to be paid here, so the net credit, instead of being $1, our minimum net credit here is going to be $99.35. And let's send that order off and see if we can get that filled. Let's go to our monitor tab. There's our working order. We're only requesting $1. Right now, the mark's 115. I'm feeling pretty good. I thought that was going to fill, and it did. Filled for $1.10. Okay, so just a smidge more downside risk protection than we were discussing. Because I wanted to talk through that because I thought that was an important discussion to be had, because there can be misconceptions about things relating to options. Options can sound super fancy. They can sound like they can do anything. They can't. They can't do everything. Now, there are other strategies that might offer a higher degree of protection. What is the strategy? If a trader is really just concerned the stock is going to collapse, but they don't want to sell their shares right away, because they could just sell the shares. Hey, earnings are coming up. I've made a little bit of money. Maybe I just sell the shares. They realize again, they're done. But there's another approach. I'm not going to get deeply into it today, but I'll mention it. Yeah, a protective put. Notice it's right there in the title. A protective put is a contract that delivers the trader the contractual right to sell shares at a specified price. So even if they collapse in value for a period of time, they have the right to sell shares at a specific price. Now, if you're not familiar with that approach, let me do this for those that are in the live audience right now. I'm going to paste a link where I discuss that strategy in detail. The webcast was called Protective Puts, Using Options to Hedge a Stock Trade. So I just put that in the chat. Let's send that off. But if you want to find that and you're watching on the archive, so you weren't here to see that link that I just put in the chat, you can go to our channel. So first of all, if you haven't subscribed to our Trader Talks channel, please do that right now. You can subscribe by going to the lower right-hand corner, click on the subscribe button, or go down below the video stream and click on the subscribe button. It only takes a second. Doesn't cost anything to subscribe to channels on YouTube. But this channel is where we house previous webcasts like this protective puts discussion I just mentioned. And you can just go to YouTube, look up our Trader Talks channel, and then click on the little search button here. And I'm just going to type in the word protective, since we're talking about protective strategies. What do you know? And right there, even using my terminology, there's Ben with protective strategies, Barb with protective strategies, and right here is my discussion, protective puts, using options to hedge a stock trade. There you go. Go enjoy that. But I also want to follow up on some other trades that are not related to this discussion specifically, but let's go have a look at what's going on with the rest of our example portfolio. We've talked about Apple. We've talked about NEE. Both of those are actually above break even thanks to the covered calls that we've done. But here are some trades that we want to pay close attention to. They are in the money and we're approaching expiration. We're not going to be able to have another discussion and revisit these. So with the Abbott Labs, bought 100 shares, paid $128.68, agreed to sell those to somebody else for $130, and the stock is now at $130, $136. So that has raised the risk of early assignment. There's not going to be any early assignment in paper money. It doesn't happen, but it can happen in real life. So let's see what's going on with Abbott. Here's the history of Abbott. We bought the stock, sold a call at 135. That one expired. We made a 132 profit on our initial call that we sold. We then sold another call at 135. We made another $1.91 profit. Most recently, we've sold the 130 call. So right here, you see where that red line starts? That's the call that we've sold at 130. We sold that on the 21st of July. Back when the stock was trading down here, stock has rallied and it's now above our strike and we're getting close to expiration. So what might a trader do here? They might, if they want to hold on to those shares, buy that call back. We'd be selling the call, we'd be selling our stock. We bought the shares for $128.68. If we were assigned here at 130, that would then be a realized gain of $1.32 on the stock. But we'd be keeping our 72-cent premium plus the premiums that we've already collected. And that would be finally realizing about a little bit more than $6 overall. With this one, I think we're going to leave it alone. Now, there's a possibility what we think that the contract might be assigned. If it's above our strike at expiration, it will be assigned with very rare exceptions. But there's a possibility stock could come back down. We just wind up still owning those shares. Next up, we have our GILD put. This is something I want to talk about today because this trade's over. It actually concluded today, which is interesting because when we first sold, this is a put. We sold a put. Sold the 18th of June, 2026 put. That thing isn't supposed to expire for another year. So why is the trade over? Well, we sold that for 310. It doesn't show a trade price anymore because we flattened the position, but we sold it for 310 and we had an order in to get us out of this trade if we could buy out for $1.50 or less, thereby retaining more than 50% of the original credit. And that's exactly what happened. So if we go look at the chart of GILD, we initiated this trade right here. You can see that blue oval. That was when we sold that put. The stock kind of wiggled around since then, but this gap up was all we needed to hit that 50% target. And we closed this out. I shouldn't say sold. What should I have said here? We sold originally to get in. Let me edit that. Change this to a more appropriate closed or bought. Space in here. Oh. Yeah. We bought those puts back, not for $1.60. Oh, you know what? That's what I was thinking. All right, I'm going to go back. Never mind. I didn't need to change this because the phrasing was correct initially. That was just making reference to the original entry. Yeah, we sold the 18th of June, 2026, $80 put for 310, but then it hit its target and we closed out for $1.60 profit. That's what those notes are telling us. In any case, nice little move up there. I do want to make this point that even when, for some traders, they might think, why would I ever sell a contract that doesn't expire for a year? I'm going to have to wait around forever for that. Well, here was a contract where we thought it might take a year, but we made more than 50% of that in just 2 months. And at no time, really, was this contract a strong threat for assignment. When it's this far out of the money, that really brings that early assignment risk way down. It doesn't eliminate it, but it reduces it really, really dramatically. So that trade's over. We're in our NEE we've already discussed. With NVIDIA, we have another short put. This is, let me show this trade. There we go. Sold that put. Stock is well above our strike. So just 4 days till expiration. I think I'm going to let this one go. Now, as we do, there's a very high probability this one just expires worthless. We have our maximum theoretical gain here. If the trader decides to hang on and to turn their head and not pay attention to the trade, which is what I'm going to be doing, we'll talk about this next week to see how it turned out. There's a possibility the stock could collapse before expiration. And we could expire in the money. That's a possibility. But I'm just going to let this one go. With Tesla, this is a covered call, 4 days till expiration. Sold the 370 strike. It's at 342 right now. It's way out of the money. Here's the history of that Tesla position. Bought the shares at 233. Sold a call here. They expired for a profit. Sold a call here. This one we just closed it out for profit. This one expired for a profit. Most recently, we sold this. It's still well out of the money, although Tesla's staging a strong rally, but still quite a small risk of early assignment while we're this far out of the money. It's still present, and the stock has some work to do if it wants to get up and put this in the money before expiration. I'm gonna let that one work. We also have our Visa covered call. Bought some shares. Right now we're in a 360 call. It's not anywhere near 360 at the moment. Here's the Visa history for that trade. Sold a put, the 330 put for 257. We were assigned on that. So 330 minus 257 left us with a break even just below 327.5. We had previously sold a put. That one just expired for 89 cents. That brings the break even down to about 320, 26.5. Sold a call most recently. We were assigned here, so we own the shares, 330, collected some premiums, realized gain on those. Sold another call up here. That goes all the way through September 19th. But as the stock is pulling back, that risk of assignment on that call is going down. We're still above break even on the trade. With this one, I'll leave that one alone. You can see that one's up $714. On the current position, doesn't reflect the premiums already collected and realized. And finally, we have that Walmart contract that is in the money right now. This one looking like assignment is going to happen. Bought the shares, assigned the shares actually at $95. Mark is at $103.96 with an obligation to sell shares at $100. Here's Walmart. Now, there's the put that was assigned. So $95, collected $162. Break even was a little bit above $93. Plus, we collected a premium of $84. That reduced the break even to about 92.5. And yeah, we've sold the 100 call. Stock is well above 100 now. If it's still above 100, we hit expiration. That contract will be assigned. We sell the shares for $100. Break even's at 92.5-ish. That'd be about a $7.5 gain net on that if we're still above that strike at expiration. Now, not every single in the money contract is assigned at expiration, but almost all of them are. Very few exceptions. So we better plan on this being assigned if it's above that strike at expiration. There we go. But that brings us up to speed with our current positions. We've had our discussion. Can covered calls really protect a stock trader if a stock is crashing? Not very effectively. If a stock is just pulling back, it can help with that. So everybody, hope you enjoyed that discussion. We've followed up on previous trades, looked at the S&P 500, even placed a new example trade. We'll see how that earnings goes on that CAH position. Not much protection. We collected what was $1.10. So that income is the degree of downside risk mitigation offered by that call. The trade-off is we now have a cap where we're obligated for the next 4 days and maybe have to sell the shares at 165. All right, let me see if I missed any questions. Mark says there's a Walmart earnings coming up. Yeah, let's go back to that chat. There is an earnings, but it's after this expiration there, Mark. It's quite probable that we no longer own the shares as of that earnings. All right, hey, everybody. Thanks for giving me your time today. I hope you'll join me again next Monday for another discussion of trading covered calls and short puts. I have other webcasts on different topics all throughout the week. You're certainly invited to join me in those. But I want to make you aware of some resources we have outside of these live streams. Number one, as I mentioned, is if you haven't subscribed to our Trader Talks channel, please do that now. Just go click on the subscribe button. It only takes a second. Doesn't cost anything. But this is where we house the previous webcasts that you can just watch on demand whenever you want to watch them. You can find the playlist of previous webcasts here. For example, for this series, you'd go to the Trader Talks channel on YouTube, click on playlists, and then 4 rows up from the bottom. We have a bunch of different webcast series. If we go 4 rows up from the bottom, there's mine, Trading Covered Calls and Short Puts. We click on View Full Playlists. And you can see last week's discussion. Hey, why some traders love volatile market conditions for this boring options income strategy. We talked about covered calls in volatile markets. That was last week's discussion. But that's a great resource for you. An additional resource is to follow your favorite presenters on X. You can follow Brent there at Brent Morris CS. You can follow me at Cameron May CS. Is my handle on X, but this is where I can post more current information in between the live streams when the camera's off. If I see something about the markets and I think it's interesting, or if I want your input on it, I can post there. So for example, I just posted this last Friday. Do you typically see strong bearish gaps like this one on FTNT as a warning or as an opportunity? People are giving me their feedback there. And I was going through this morning and reading those comments and replying. Yeah, big gap down on FTNT. We'll see where it heads from here. All right, but great resource there. Everybody, Thanks for clicking the like button. I can see 146 of you watching right now, and it looks like 53 have already clicked the thumbs up. That's always appreciated. It always helps. It actually gives a boost to the presenter's webcast, and the YouTube algorithm helps more people find these sorts of discussions. And it sounds like applause to us. That's the way it feels. Always appreciated. Finally, fill out that survey for me if you would. That definitely helps. So click that survey link if you're here in the live stream. Give me some feedback. I will definitely read your comments. I definitely read through that data, and it always helps. Everybody, thanks for giving me your time today. I'll look for you in a future webcast. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.